All right. Yeah, Mark Nelson, Kansas Farm Bureau, Director of Commodities. And I think we're going to follow that same format that we have in the past. I'm going to kind of run through a few things here, 12 slides or so, turn it over to Dan so he can give you some great outlook information. And I try to be, I don't want to say practical, but maybe look at some of the decisions. We talk about marketing plans, we talk about decisions, and then Dan gives us that last piece of information, where are these markets going to go so that we can all start implementing those plans. And I like to start with this one. What goes into a marketing plan? Pretty much everything, right? Production cost, quality, local markets, timing, tools, storage, all these things go into, and we try to pull all that together in our marketing plans. Oh, there we go. And typically, for our process, we try to start our pre-harvest feed grain and soybean plans by January 1. This past fall, we were kind of talking about maybe even starting some of those things earlier. I know a lot of producers do, probably a really good idea. Post-harvest plans, again, typically we'll look at feed grain, soybeans in that September, October time period, May for wheat. And then throughout the year, trying to do implementation and you're trying to make decisions and follow through on your plans. So basically, as I create this format, this sample thing for people to look at, we're kind of starting this thing in January. Now, effective marketing plans have got to include a lot of different things, right? Pricing increments, which means how much each time am I going to price? 20,000 bushels, 10,000 bushels, 5,000 bushels? You've got to make those decisions, and because that also impacts how many decisions you have to make. We need to think about how much do we want to price post-harvest, pre-harvest. We may only want to price a portion pre-harvest because we're just worried about drought, et cetera, which makes a lot of sense. Price targets, which is the price or the profit that you'd be willing to sell out. And the best thing you can do is get that written down, make that part of that plan so that you can refer to that. And then date targets. And these basically are designed to compel action because we may not always hit our price targets. And so our date target then drives that ultimate decision. All of these things coupled together with the pricing tools you select can guide decisions, they can lead to action, and again, hopefully take some of the emotion out of marketing. Now, I want to kind of go back. Back in September was the last time we all talked, September 23rd. I think Dan and I were kind of showing some charts that said, hey, basis is pretty wide right now. People should be maybe thinking about hanging on to some of this corn because basis was so wide that there should be some opportunities for basis appreciation, which would give us a return to storage. Okay, so since September 23rd, March futures have taken off, right? And I'm going September 23rd to last Friday, January 24th. I know we're trading down a little bit today. But in that time period, September March futures were up 67 cents. Cash corn prices collectively were up 77. In my chart here, I've got 6 locations across the state, and I'm just going to use that 6-city average of 466. And so over that 4-month time period, we have seen quite a bit of price appreciation and a little bit of basis appreciation, but not nearly as much as I thought for sure. I thought we were going to see that thing narrow up. And on my chart here, I've got the 3rd week of February, 221, that column. That's the 3-year average for each of those 6 locations. The average is 16 cents above. The average for those places locally right now are 21 cents under. So again, while we've seen some appreciation, we haven't seen enough. But because prices went up so much, our returns, if we did store, are high, regardless of whether it's in commercial storage or on-farm storage. Again, I've got costs for these 2 months, basically. Once you get it in the bin, we got December, January now so far. So roughly 2 months you've had it in storage. On average, about 15 cents in commercial storage, about 13 cents on-farm. And that gives us some pretty significant storage returns. So, I'm sitting on this grain. Question is, what do I want to do with it? Right? So we're significantly up since September. Do we sell the corn, take the win, and focus on new crop? Some ways I like that idea, right? Sell the corn, let's stop it. We're done with 2024. That's one thing we could do. Another thing we could do, though, is keep storing that grain, right? Waiting for basis to narrow or prices just to keep going up. Again, I want to see what Dan's got to say because I think he's going to share a lot of things. And then what I've got here now is those same locations, but my columns have changed. My columns have changed a bit. I've got in there the current prices as of last Friday in all those locations. I've got July futures, and so I'm kind of trying to project out. Okay, what would happen if I hung on to this grain? Okay, so now I'm using the 3-year average for July 21st, which is roughly the third week of June. So we'd still be using that July contract at that point in time. Same kind of thing we saw back in September, though. Boy, expected basis appreciation is massive, right? Basis has got to narrow, right? Well, you know, we'll talk about that a little bit. I got a slide on that. One other thing I want to point out before we move on here is it's important where you have it stored. Because the way I kind of calculate storage, you know, I kind of throw on an in and out charge of 5 cents on farm storage, and I take a 1% shrink. And because of that, you know, for the first 2 months, storage costs were pretty similar. But as we go from today, and my idea point being is if you got it on farm storage, a lot of those things are sunk costs. And so now as we go forward, we really don't have a whole lot more of added storage to expect. And on average, going clear out till June, I'd say about 15 cents for on farm versus commercial storage, where, hey, I'm probably paying 6 cents a month, right, for storage on top of interest. And so because of that, you know, your storage costs going forward are much higher. So, you know, when we're thinking about, do I keep it in storage? If it's in commercial storage, that's going to make you kind of lean a bit more towards considering getting rid of that thing, because we're going to have to see some pretty sizable increases in cash prices. For example, you know, we're going to have to see an average of 510 versus 466, which, you know, is a pretty good size run up. It doesn't take nearly that kind of a run up to break even with on farm storage. The third thing we could do is sell that corn and re-own with futures or options. Because right now, you know, it's futures that took off for us, right? Cash prices went up, but we're not seeing the basis appreciation. Now, a little bit on basis. This is a Ag Manager basis chart. You can pull them up. I hope you all have. I think it's great information. It's Salina corn, and I've got several years, about 8 years there, along with the 5-year average. And the thing I want to kind of point out with this is this. Often, once harvest begins, that year's crop year fundamentals can significantly impact basis. And basis is often either strong or weak for much of that crop year, right? And I guess I'm kind of showing here, you know, that July futures, when it switches there from July futures to September. And in particular, let's look at 22 crop. That's that green line. It really popped up when we left July futures and basis, and we went to September. Why? Well, okay, let's see here. We had a fairly small crop in 2022. I think everybody's aware of that, right? We had low production, and so basis was tighter. And as we went from 22 crop there, that green line, it flips over there in week 45. We're switching over to the March contract. Weakened a little bit, but was still fairly strong. March contract going through there in January, still very strong. And my point being that 22 crop year basis was stronger. But as we approached that switch off there in the middle of the year, week 25, it started to weaken. And so here's 2023 crop. And again, you know, in Kansas, we rebounded a bit, right? We rebounded. We saw a better crop in 23 than we did 22. The U.S. as a whole had a much better crop, right? We jumped back up to 15 billion bushels. And so basis was once again weak, and it continued on the way through. So again, my point being this, typically, you know, these charts are always in a calendar year basis, but when you think about it on a crop year basis, typically basis is going to be relatively strong or relatively weak, which means, I guess to me, then this is a bit of an argument that we may not get much help on basis. We may see prices rise, both cash and futures, which makes storage a good idea maybe. And waiting for potential new crop sales later too makes them all possibly good ideas, but don't expect maybe that we might see any strength in basis for crops you have on in storage. All right, which now brings me then, okay, so making some of these decisions, I just want to point out a couple of things. This is the July corn futures contract. It's not in your handout, I apologize. But we had a very significant level of resistance there at that $5 area. You know, back in July of 2024, we couldn't get through it. And then here we come into January, we had one close above it, we closed back down, we had one close above it, and now we've had 2 consecutive closes below it. looks like we're going to do today. So we have not been able to get two consecutive closes above $5. That's a fairly significant line of resistance. Once we pop that, once we see something, and Dan will talk about the fundamentals that could drive that, well, then this market's going to go up. And I think the next level is about 520. There's another level of resistance that we need to worry about. So maybe on post-harvest, if you've got some stuff on storage and you're wanting to get it moved out before you get too busy in spring, if we can pop above $5, that might offer an opportunity to maybe price a little bit of that. But if we pop through 520, chances are you may want to hang on to it because it could actually increase in value more. But as this shows, again, since December, we've been on a fairly sharp increase in prices. Now, when we think about post-harvest marketing decisions, let's go back to that third thing, number C, selling the corn and reowning with futures or an option. I'm going to go through three reownership strategies. And again, I'm kind of basing it off things where we were Friday. One of them, that column A on your chart is buy futures. Now, really, that's the most risky, right? Because with any significant change in futures direction, it's going to gain or lose the most. So, sometimes that risk is good, right? If we see some very positive developments and we see July go from, say, $5 is $4, whatever, where we are now, to $6 or $6.50, okay, if you bought futures, you're making all that. That's great. But if we would see something very negative, a trade war that would really dampen prices, possibly, and we drop $1, that's $1 in loss. So it's the most risky. The next thing we could do, though, is buy an at-the-money call. And you can buy any kind of call, but my example is an at-the-money call. So I'm looking at a $5 call. Last Friday, that thing cost 27.5 cents. That's what's at negative 0.275. The nice thing about that, it puts in a floor because your initial cost, after you pay for the premium and your hedge cost, is about 29 cents a bushel. But that's the most you're going to lose. Again, on futures, we don't know. Okay, the third thing we could do is what I call a call spread, and that's buying this at-the-money call, but then selling an out-of-the-money call. This would be higher, which reduces your overall premium costs, but also limits your upside potential. Because once, so I've sold a $5. I bought a $5 call, and I sold a $5.50. So once futures go from $5 up through $5.50. I'm in good shape there. But once we go past 550, those two offset each other, and I'm not really personally gaining. So again, the maximum you can lose is 29 cents with that option B, just buying an at-the-money call. But the most you can lose with that spread is 17 cents. And I kind of want to just show a couple of things. So if we see futures go to up to 525, so we kind of broke through that 520 lane, futures are at, you gain 27 cents. When you add that to the 466 from selling the corn, you'd be at a net of 493. Buying that call option, we still haven't gone up high enough because our break even is 528.5. You're still down a bit. Your net is 463. But that option C, right, we're doing a little bit better. Made 8 cents even with that. If futures go down 25 cents down to 475, my futures position is going to net me out of 443. And now we start at 438 on the call, 449 on that call spread. So that's pretty nice. Let's flip them out and make it a bit more dramatic. What if futures go to 575? Well, that futures position, if you sold futures, now you're up 77 cents. And so your net overall post-harvest position is $5.43. That's 77 cents plus the 466 you would have received by selling the corn. Your option, just buying the at-the-money call, is 513. And then C, you start seeing that limit, right? You're pretty much capped at the most you could do is 33-cent gain and a 499 net. But if prices go way down, 425, futures, your net, right? You lost 74 cents in the futures market. You add that to what you made on the corn cash market, you're at a net of 393. You're at 438 with your just buying an at-the-money call. But with that call spread, you limited your losses and you're at 449. So you got to, we need to listen to see what Dan says about what our potentials are. And you need to find what, alternative is the best thing you could do. Again, we're thinking, sell this corn, get it out of storage, be done with it, focus on 2025 crop, or continue to store it, or B, sell it and maybe re-own either with futures or some kind of an option strategy. All right, so if we're going to focus on new crop, I always like to start with this. Key thing is timing. And what this is a CME Group December Corn Futures Index, including last year. Basically, it's a January to November analysis. And so it takes all those daily prices, divides them by the average that occurs between November and January. Okay, so that's the way to look at this. But it shows that once we're starting harvest there in September in Kansas, and we're 42% harvested, say by early October, and 75% harvested by the third week of October, all those times on a seasonal basis, you're not going to get as good a price as you might see in that April, May, and into that June time period. So my point is, we have opportunities in May, June, and maybe early July where we have opportunities to get a better price than what we might see at harvest. So this is another way of looking at that. This is each of those years. And again, it's kind of a January 1 through September 30 new crop analysis. And so, for example, I'm going to read across that line. 2010, the price on January 1st, the first trading day, CME December corn futures, it was $4.45. The highest it reached between January 1 and September 30 was $5.22. So it was a 77-cent change or a 17% price increase. Go down to the bottom of that page, you look at last year, it was $4.98. The highest it got was $4.99, 1 penny higher. Throughout from January 1 all the way through September 30. Now, I do want to point out in 2010 and 2020, both of those years, for example, that peak out was at 522 in 2010. It actually did trade higher than that and above 522. And in 2020, the high was 405. But finally, post-harvest, we did see the December futures contract go higher. Now, I'm going to put these in order. Best year to worst year, okay? And it kind of allows us to draw some lines, right? I'm going to start at the top. 2012, 2011, 2022, and 2021, we saw $2 rallies from January 1, somewhere between January 1 and September 30. Massive rallies, up over 40%. A great opportunity. That happened 27% of the time. If you go throw in the next 4 years, and 53% of the time, we had at least a 65-cent rally. And again, the next one, 80% of the time, we'll have at least a 20-cent rally. But there has been 3 years where we basically didn't move at all from January 1. Okay, so you kind of want to build that into your plan. Now, the other thing we got to look at is what is a good forward cash contract? Because I know a lot of folks aren't using futures, aren't using options. We're using forward cash contracts. And again, something I want to point out is that basis over the last few years has been relatively volatile. This is it for Cornerstone Ag. 22 is marked there. And what it does, though, because typically what I would tell people is take a look at the 3-year average or the 5-year average and use that for when you want to sell. Maybe that's your best estimate of what a good basis should be. The trouble is volatility has made it very difficult. Right? If we look at, for example, if you go and look at week 39, okay, and that's when 75% of the Kansas wheat crop or corn crop is harvested, the average for Colby's 21 cents. But obviously that's kind of being skewed a little bit by 2022. So maybe we want to adjust that, and maybe you're looking at maybe more like 9 or 10 cents above or positive would be a better estimate. This is another table very similar to the other one. I looked at those same 6 locations. I've got December corn futures. These are examining new crop bids, again, from last Friday. So December corn futures closed last Friday at 461. Colby at Cornerstone was 441. So the actual new crop basis was 20 cents under. And again, I kind of pointed out there, the 5-year average the 5-year average new crop basis is 21 cents over. So again, way weak, very weak. If we kind of adjust it though and kind of grab that, somewhat in the middle one, maybe 9 cents is a better estimate, but still even there, that's a pretty negative basis. And you really see that everywhere as you crawl all across the state. The one place, Garden City, though, They're at a zero basis, 461. That's really, I mean, that's spot on with the 5-year average. And even if you tried to adjust it, kind of looking at their chart over several years, maybe you balance it up to 5 cents over, but that's, probably right in the ballpark. But other parts of the state, we're really seeing some fairly weak basis. Topeka, Chanute, those are a little bit weaker than what you might expect. Well, no, I take that back. Chanute's pretty much not that, not a bad one. They're really given if you look at the adjusted. But Topeka, Haven, Concordia is pretty close to being about a spot. So we're seeing some spots, Colby, where it's much weaker than you'd like to see it. Okay, so pre-harvest corn implementation. Again, we started this plan January 1. On January, the first trading day of January, we were at 446. Again, we have seen a pretty decent little rally, right? But if we were looking for that 20 cents, right? 20 cents, I have a target now for my first increment at 466, which would be a 20-cent increase in price. We haven't hit that. We've had some resistance at 460. We kind of blew through that. I think we're trading down below that again today. So again, that's kind of a resistance area. We haven't been able to, we got 2 closes, but we weren't able to get any more. But if this thing pops up more and we've got plenty of time, I don't know. I guess we're still hanging in there. So I guess from my standpoint, I like where we're at. First increment, I'd like to price 20% at a price target of 466. That just gets me in the ball, it gets me started. But I'm looking at that April, May being my date target, that time where if I don't hit 466, I'm going to go ahead and price it anyway. But if I get above that, I will price it. Another place, that'd be a good place, 20 cents. Another one might be a 33-cent rally up to about 40.80 if we can see that. That might be another place to maybe do another 10%. With that, I believe I'm going to say thank you very much and turn this thing over to Dan. Again, help with any questions once we're finished up.
Thank you, Mark. I appreciate your insight on that info and want to follow up and support what you're saying and look at both the current situation and give some thoughts for discussion on strategies going forward. So first, a quick look at the weather. It's too early for most of the corn trade to be much concerned about weather conditions, but just as a note, in our first webinar here for the year, first monthly webinar, pretty dry in the parts of the Eastern Corn Belt. Really, you can see there in Illinois, Indiana, Ohio, Michigan, Iowa, dry also, not as dry as those other states, Eastern Nebraska, etc. Really, for us here in Kansas, we're probably looking as moist in general as about any place. Quite often, in the last several years, the driest part of the country has been the southwest, south central corner. Well, this year we actually have some moisture. It's more the north central and eastern third that have more dryness. So this is just a predicted soil moisture anomaly going out to February the 1st. We do have our eye on some international situations. Of course, I think the main information or the main spot where there's some concern in the world situation has been in Argentina. Dry conditions, you can see some of that here. I'll show you another map, a NASA satellite map shows a little bit worse. Brazil is kind of a mixed bag. It sounds like Mato Grosso, a primary key player, has a fair amount of moisture, and that's probably that little spot right there. But other places not. So Mato Grosso right now is holding up the rest of the country in terms of projections for yields. Although when you pay attention to their groups, they're shaving about 1 million metric tons per time you hear them off of the corn and yield projections for South America, for Brazil and Argentina. But again, there's a next couple 2-3 months will tell the tale on that. And you can see this map does not show many problems up in France or the Western EU, dry conditions in wheat production areas of Russia. Really not no major problems on this map in the Ukraine area. In mixed situation in South Africa, etc. They did have enough crop damage earlier that there were thoughts that they'll be importing some grain this year. Normally they export a little bit. Not big problems in China. You do see in that to the east in some of their key production areas some drought showing up. Some drought showing up in India, although I haven't heard a lot of reports of that. And of course, we watch Australia, and Australia actually by this map has been showing more dryness in these northern areas as you see it going forward. This is a map comes out of NASA. That's the NASA GRACE project out of UNL. Shows us more of a satellite view than that map I just showed you, and you can see in South America more of these Argentina, parts of southern Brazil having problems, more moisture elsewhere. Which really shows up more is that there's a likelihood of more crop damage if if we go by this map in Russia, in Ukraine, parts of France, Germany, and all. So it's a matter of what you follow. I think this is almost, I'd call it a leading indicator of where things are going. By this map, you have more dryness showing up in parts of China, but you listen to news reports and you'll have a report from either an independent group or a government agency, and they say, "Oh, we're expecting records." Well, that's still their expectation, but they're counting on moisture to come. And you can see how this map looks a little bit different with regard to Australia. Let's look at feed grain markets. Thought I'd give kind of a rundown of key feed grain market issues, at least as they appear in today on January the 27th. I guess I classify the current marketing year 24-25, started September 1 of 24. We will run through the end of August of this year with really lower U.S. ending stocks. That came out of that January 1st USDA WASDE report, 1.54 billion bushels. And we were closer to 2 billion bushels when we came into fall of last year. Well, now through increased usage on the one hand, USDA adjustment sharply lower on the U.S. yield on the other. Now we're down to 1.5 billion. And when we've been tight at pipeline stocks and had really strong prices, we were down to 1.2, 1.3, et cetera. So some of the strength I think that's happened in the corn market is because this number's been whittled down, and if usage continues, absent disruptions from trade or whatever, then we're heading in a direction that'd be pretty supportive of prices. Stocks to use standing above 10%, just above 10%. That's down 2 or 3% from where it had been. So I think with this situation, you can classify the corn market both domestically and internationally as tight. And I know that, gosh, how come we don't see prices really running up? But it's a tighter situation. We have basically 1.5 billion bushels of carry out, and you're getting pretty close to having pretty strong corn markets. And with this tightness, when you tighten up old crop ending stocks, which is what this is a projection of, then you're also tightening up new crop beginning stocks for the 25-26 marketing year. And with that, you have less of a cushion, quote, to fall back on of excess supplies to work with if there's any risk to the U.S. corn crop in the coming May to September crop production season. So that I'm not, with this perspective, I'm not entirely bearish. I don't think we should be entirely bearish on the corn market. Actually, we've tightened up, and that USD the last few WASDE reports, the solid numbers that the market is looking to work with, are showing that. We have some emerging crop risks in Argentina. Of course, we've talked about the drought of late. Brazil, really their issue has to do with moisture that's been coming and delaying their soybean harvest. Well, as I recall, I think about 80% of their corn that's grown is a second crop corn, and that's the one they mainly put out into export markets to compete with the United States. And uh, the delays in planting the Brazilian, well, in harvesting the Brazilian soybean crop, pushed the planting window for their corn crop out later, and generally acknowledged, understood that when you have a later planting time period, uh, planting window for that corn crop, then it's pushed out further into their hot season. So it may impact what's happening down there, may impact the 2025 South American crops and exports. And if you keep whittling down their production prospects, that ends up being a positive for U.S. corn, because in the world, they're basically, well, you have a number of countries that'll sell grain export wise, but it's mainly the United States, Brazil, Argentina, and it was Ukraine until the war impacted them. Other countries getting involved, but you've got about three big ones and some other players too. And if you tighten up South America, then it pushes business to the U.S. Lagging grain sorghum exports mainly to China. Again, the Chinese buy and are on the books to buy half, at least half or more. Well, I think it's more like 90% of U.S. sorghum. They have been buying some, but you look at that chart and the business in the last few weeks, it's been horizontal. We haven't had hardly any sales of sorghum, and you just can't help but think that's likely tied in with some of the impending trade discussions with China in particular. And that brings up the issue of U.S. trade and tariffs policy. We don't know what we don't know if what's being communicated will result in retaliatory tariffs from other countries or not. That doesn't affect us for our domestic usage directly. Indirectly it could, because if our exports get cut off, both the direct products and like for soybean meal and oil, what we'd be shipping in that for those, then you end up and would have a negative impact on the margin for U.S. grain markets. And for us, this highly charged political issue, as from Kansas State University, I'm sure Farm Bureau the same way. We have to walk right down the middle of the road. we have to just say what we understand to be, and you're having some pretty strenuous discussions with regard to this. I don't know that the new administration, the Trump administration's trade team, is even all in place yet. So I understand, there was a date thrown out last week, February 1st. Well, if we're going to do something, that's when it's going to happen. Well, that may happen, but I'm not sure all the people that would man those trade offices are there to work out the details yet. So stay tuned. In fact, one day here, the day after the inauguration, I think it was the 21st, the market suddenly rallied. You look back, and their reason stated for rallying was that, well, we thought after the inauguration we were going to immediately place 60% tariffs on everybody. Well, that didn't happen, and so that shows. So Mark, a lot of what was happening, apparently, if that's what was holding the grain markets down, a lot of what was going on was just the fear of tariffs that kept markets from responding even more to the in the corn side to higher I guess to tighter stocks. Just interesting to see it play out. So, but what that does, okay, before we go on, that means there's a source of volatility, either negative or positive, with regard to how that works out. That's waiting out there. And if February 1's the date that when things would actually be announced, Well, that's a day of a lot of uncertainty in the market. So when we're looking at opportunities to sell, and on the one hand, and things to be wary of on the other, these trade announcements are the market's really responding to whatever comes out on that. So I don't know on the what the impact will be actually on the supply demand numbers, but the sentiments of the market seem to be pretty sensitive to that. We've got weak corn, sorghum basis in parts of Kansas since fall of 2024. And the basis level, just as Mark showed in a number of these areas, particularly out in western Kansas, northwest, parts of north central, et cetera, uh, really they began last fall. They carried over into the first part of this year. If you just look at the last 4 years, we have the weakest basis for corn we've had in well, since 2022, 3, 4, and now 5. So if you go back farther, you'll find some pretty weak years. But in the last 3 or 4, we're definitely the weakest we've been in a while. And why? I think that as Mark, as you were showing on your chart, for the corn market, we got up to the 435, 450 area from being as below $4 in August, September, and it seems like a lot of judicious folks went ahead and sold, and they were pretty wary of how low prices would go. So we must have sold quite a bit of grain at that time. So the report I get from farmers in western Kansas, we had a Cover Your Acres conference last week, was that they'd like to take advantage of higher corn prices, but when they go to the primary buyers, the feedlots, ethanol plants, whatever, then they're quote full up for at least a period of time out into spring, if not farther out. So a lot of people must have taken advantage of those of the run up to 435, 450 at times, and sold. So it that in those areas affected, it impacts. Well, it makes it at the local level less of a seller's market, more of a buyer's market. They're full up. They'll wait and see whatever happens. We still sell elevators, but the basis offerings will reflect weaker demand, at least locally, for a while. What'll happen in 25? Higher corn U.S. plantings are likely, and it's not that things are just doing wonderful for corn, but for wheat, for sorghum, for soybeans, we've got weakness happening in those other grains, and so it's likely, at least that whenever any estimates I've seen, people have talked to, that will probably move a bit higher for corn because, hey, we have a comparative advantage in corn. We can do it well. We have places to sell it throughout the year, and so it looks like we're moving towards higher corn plantings and probably sideways to lower soybeans at this time. That's a change from where we were about 2 months ago when soybean prices were doing pretty decent and corn prices were in the doldrums. And ethanol regulatory policy and trade issues likely to be impacted by actions of the Trump administration. We've got the 45Z regulations that haven't been fully implemented yet. Now a new administration involved. The issue of E10 versus E15 still out there. I'm not exactly sure where small refinery waivers are at. That tends to be fought out in the courts, et cetera. So for what we have going in the corn market, probably the best things we have going are feed usage and ethanol use. And if energy policy impacts ethanol in a negative way, that would hurt the corn market. And we'll be watching corn, sorghum market seasonality out into the spring and summer. Here in the last 5 years, the top of the market, cash-wise, has been coming in May. And that's a change from the previous back 15 years when it was a May-June affair. Well, but if anything, at least of late, it's been more of a May deal. So Mark, in our plans that we're looking at for new crop sales, that very likely is an issue. Just to show you some things quick, Want to move quick on this. Uh, so when you stand back and take this long-term view of the corn market, of corn futures, it's a volatile neighborhood that we're living in. And you know, this last run, yeah, we got down to 385 here in August of last year, but we were 2 years ago up to $7, 8.25, and you can see the type of volatility that we're in. So and Mark, your when you showed that chart of moves since January 1 and lined them all up, et cetera, they're following this type of stuff. And you're looking at within year moves, some of the major moves that happen with drought, wars, financial crises, et cetera. So it's a volatile time frame, and it's probably judicious to think pretty conservatively. Give me a 10-cent gain, 20%, 20-cent gain, 40, 50-cent gain. I understand that, but it is not out of the realm of possibility at all to see much larger moves because we've been living it since 2006. And just wanted to show you this. The corn futures have turned positive. Managed money traders, their net long position, and this is, if you go over here, this is 2,000 million bushels. So that's 2 billion bushels, 1 billion. These are the long positions that managed money traders or speculative traders have. The short positions are in the red. So last fall, we were at a near record short 2.55 billion bushels. Now we're basically since 2012, we have the highest long position that we'd seen, at least as of last, I think as of the 21st, that we've seen since 2012, since the drought. So the neighborhoods has a lot of opinions in it right now, and turned a lot more positive than it was last fall. And so here's the season average highs. You can see here coming out of January into February, not a lot happening in general, into February, March, but then into planting season, into April, into May, still pretty high in June. That's the red line. But then if a short crop doesn't come, then has fallen off pretty readily. And that's getting to be a more extreme move out into May the last 5 years than it was the previous 5 or 10. So when we talk about the seasonality of storage for old crop, the seasonality of new crop futures on the other, this kind of informs my opinion. I think the spring has been quite volatile, and I wouldn't want to underestimate the potential for price moves if we have any problems here in the U.S. at all. Just do want to say quickly on cash markets for Salina, 461. Well, you look at the best bids of late. Again, price leader in the area for corn, 507, 21 over. And I understand that matches the multi-year average. We've been running the last few years more like 40 and 50 cents over. When we had drought, we had $1 or $2 in front of that figure on the high side. So that historically over a longer period of time, that's a pretty good basis bid. Over the last several years, it's less than what we've been seeing, and strong leadership. But note that out here in Western Kansas, 466, 467, that actually the highest bid has been in the Colby area, just about the same in essence as to where Garden City is at. Note out here, pretty strong bids in the Pittsburgh area. Hutchinson, 471, the south central southeast. And the new crop ratio of soybeans to corn, with 2.3 being neutral. Topeka in the east, basically Salina, north central, pretty much Hutchinson in the southeast, and arguably Pittsburgh, all at 2.2, 2.5, 2.3, pretty much neutral, maybe neutral for soybeans versus corn. Get out to the west, 201 in Colby, 206 in Garden City, definitely leaning towards corn acres as in terms of the new crop soybean bids versus corn bids. Note this little critter down here that the spot cash price for hard red winter wheat is less than the spot cash price for corn in Garden City area. So that's at least a signal that we have interest out in this western part of the state to feed wheat. It's getting that cheap, especially in the Garden City area, and where the feedlots are. That's where we do it largely, and you have that incentive. And just wanted to show this quick, and then I'm gonna move on because of time. Note here, Cornerstone Ag, but across again, Mark, I'm deliberately looking at the most recent years as opposed to, I think you were looking at the last 7 or 8 or 10. I'm just looking at the most recent ones. And in the northern part of the state, we have the weakest basis bid across the board for corn. Well, these are selected elevators. You can see there, and we have a fairly weak basis bid in the southern half of the state as well. But it didn't just these weaker basis bids didn't just start in January. They're carrying over the red lines that happened in 2024. So we got weak in the fall and we just carried it over into the spring in these situations. Okay, I'm gonna move on quick here. I do want to show that. So this is from a supply demand balance sheet point of view. This is how the percent stocks to use and prices are compared. And so as we went to from 9.9% 2 years ago to 11, almost 12%, price dropped basically $2. And here so far with pretty weak prices last fall, the season average price is down a little bit lower, although this recent report, we dropped stocks to use. In my own thinking here, so yeah, USDA, let's at this point, let's say, okay, we'll say 7 out of 10 chance that you're right. But there's some other scenarios out there to look at. But if we have a trade situation, we drop 100 million bushels of corn exports, then you just add that back on to ending stocks, and you probably when I look at the stocks to use and price relationships, you very likely drop the season average price about 20 cents. But if ethanol usage continues on the higher side, feed usage stays strong, you add basically from 50 or 100 million bushels of use, drop the stocks, then you're at 440 to 465. Interesting, futures on Friday, they're bidding, when you put the futures prices in a reasonable basis bid across that, the complex of prices, you're ending up with futures at about 443. So if anything, the futures are kind of matching up with a scenario where somehow you get about 50 million bushels higher corn usage, and ending stocks go below 1.5 billion. You're below 10% stocks to use. You're about 440 prices. So that'll have to play itself out. Did want to show here for grain sorghum that seasonally very, very similar to corn, but again, not a lot of movement expected, at least historically, from February into March. But then the red line shows what the futures are bidding. They're basically running up until March and then just going sideways. They're going sideways right through the time out into April, May, June, when we have a whole lot of volatility. So I understand what the futures are doing, but I wonder if the futures markets are valuing the uncertainty of on the production side as actually exists. Cash prices for sorghum, you can see basis bids lower than for corn. Strongest cash bid actually in the Topeka area at 441, 437 in Colby, 436 Hutchinson, and you can see where all that's going. And basis for sorghum also weak. So feed grain marketing strategies, old crop storage return opportunities into spring summer 25. Another one, and you talked about this, if strong corn futures rally occurs often in the spring, but the basis remains weak, and that's kind of what we're expecting right now, given what we'd heard about with cash, what's going on in the cash market. Then we do things with forward contracts or the futures that can tie in the futures price, but leave the basis uncommitted to until sometime out in the summer, et cetera, where we would hope we get better basis bids. Those are hedged to arrive contracts, i.e., basis later, or short futures hedges. Could consider selling cash, buying call options, and over time. Mark, you remember our good colleague Kevin Duvetter would talk about this, and he'd say, "Yes, you can sell your cash, and you can buy calls. We're declaring that we're out of the game for any basis appreciation. You're taking with the cash sale whatever you got, if it's a wide basis, etc. You're hitching your wagon completely to the futures running up, and that's not bad, but that's the issue we'd have to wrestle with. New crop, use a scale up pricing, targeted action date, forward sales plan, kind of what we talk about in our winning the game strategies. This is my opinion. I have run this by Mark. Probably $4.75 to $6 on a monthly basis, looking from March to August, about once a month through there to work your way up to $6. Probably marketing up to your potentially up to your revenue coverage APH bushels on your grain. Let's look at wheat, and so I'll go through the market issues and strategies for wheat and soybeans as well. This year, we've got growing in stocks of just about 800 million bushels. When things are tight, we tend to be about 500, and the stocks to use were at almost 40%. 2 years ago, with about $6.54 average prices, we were at 30 or 29. So the wheat market is oversupplied, but still at risk to anything that would happen weather-wise here in March, May 25. So domestically, we're oversupplied, but still crop problems coming into this spring would certainly impact the market. Probably take us back down to if they were bad enough, tough enough, back down below 600 million bushels down to 550 or 5. Drought risks in Ukraine, Russia, and we show those on that map. They may impact 2025 Black Sea wheat crops and exports. That'd be positive U.S. exports, but it is tough to know what the Russians are doing. They'll say we're doing that. They'll be more optimistic than not. I think the thing to remember for these countries is that they don't tend to store grain. We with our infrastructure can store grain. We can finance grain. We're not having generally people firing missiles at our ships or our storage units. So we're more set up than they are, and we're not fighting wars. So when we produce wheat, we can hold it more so than these folks. When they produce it, they need the cash. They're exporting it. So it's a difference in our position. Lagging U.S. wheat exports to all major buyers. The worst class, unfortunately, is what we grow largely in Kansas, hard red winter wheat, and struggling the most. And this is almost just obligatory. U.S. trade tariffs policy may impact the wheat markets. We have to see how that plays out. Weak basis for wheat since fall 24. And again, I just put that right back on poor exports. We're holding wheat. There's not that the mills are buying wheat, yes, but we're not seeing that demand pull wheat down to the Gulf, put it on ships. So we tend to languish. Due to, again, high value of the dollar works against us, and these aggressive export sales by Russia and Ukraine. And we're watching for market seasonality. Something would happen on the supply side, on the production side, April, May, and show you here that I'm going to show you a seasonal graph that's surprising for wheat. For futures, we're 559, we're back down in this area here where not a lot is happening. Wars, droughts, financial panics, tightness, that's given us much higher wheat prices over the years. We're here right now with not anything like that happening, and we're just, again, I think languishing is a favorite, is unfortunately the most descriptive word for the wheat market. And you can see for managed money traders, uh, almost well 255 million bushels long positions, 445 short positions, so definitely a bearish tinge. And just note here, if I don't know how many Kansas farmers on farm are keeping wheat all the way out into March, April, May, but the last 5 years, that's when the highest cash prices have been. They were even that way prior to that, but it's really extended itself all that much more the last few years. But gosh, that's a speculative cash situation where you're holding wheat that long, paying interest on it. In commercial storage, almost impossible. On farm storage, less of a deal, but you're still paying for that too. But yet the seasonality of wheat old crop sales has been coming out in April and May right before the wheat harvest. Cash bids, again, best bids, 539, 540. Hutchinson area, the worst bids out to the west, below $5. New crop bids, again, Hutchinson, Topeka, Salina, all that 540, 538, 541 area. Unfortunately, at the Colby area, the weakest new crop best bid available, 494. Okay, just wanted to show you quickly. Note this is all U.S. wheat exports not doing great. Hard red doing in the lower part of where we've been historically since way back 2015, 16, just struggling. Okay, did want to show you here for wheat as stocks to use has gone up. We've seen the cash market move downward. I think it's a matter of if the USDA is right, we're about 555. We're struggling to meet the USDA's projections for exports. You could easily take another 75 million bushels off of that, and that would take us even lower to 505. If wars, drought, a major drought in Russia comes into play, Russia, Ukraine, as we saw on that map, well, you could add a $1.20 or so to that market pretty readily. But that's a roll of the dice based on a weather outcome. Okay, just want to show you here for sales for wheat strategies, storage, return opportunities. If we're still holding wheat into April, May of 25, we're counting basically on some type of seasonal strength. Really, same situation for wheat. If a strong hard red winter wheat futures rally happens, but the basis is weak, then we're in the same boat of hedge to arrives or storage futures to lock in futures and wait for better basis bids. Or Mark, as you said, maybe we just sell it, be done with it. Consider selling cash, buying call options. Again, we're kind of giving up hope of a basis improvement. New crop scale up pricing, $5.75 to $7, February to June, and so we're looking for something to shake up the market that we're not anticipating right now. So that would be how that goes. And for beans to finish up, current 25, moderate U.S. ending stocks. I think that's 380 million bushels. Stocks to use, 8.7%. The stock market isn't tight, but it's not overwhelmed like it was either. Still at risk to anything that would happen in the growing season, May, September. Emerging crop risk in Argentina, drought may impact 2025 South American crops. Really pretty strong soybean exports to date, and really to China. They're in the market. But gosh, if the biggest worry on tariff retaliation would come between the U.S. and China, if China decides to slap higher tariffs on U.S. Ag goods, and that would hit soybeans the worst. And so that's a risk in that market. We have had really good soybean oil, soybean meal exports, been great. Mostly weak soybean basis since fall, unchanged to lower soybean plantings right now. Again, and that's kind of reversed from where we were November, December when soybean prices were leading the way higher. Uh, Biodiesel regulatory policy and trade issues likely to be impacted by the Trump administration. We just have to see how that affects renewable diesel. Really, the issue there probably has to do with what the Trump administration does in places like the West Coast on what they're requiring, what they'll be requiring for vehicles that function out there. Is all that off the board? Now, I think a lot of that may have been rescinded. I think it was almost immediately when that administration came in. So I'm not sure where that leaves renewable diesel quite yet, given all that stuff. And we'll be watching for seasonality. Let's go back here. That we'll finish up in terms of the marketing strategies for soybeans. In essence, about even money in terms of going higher or lower. If we add, my thoughts are that we've got a pretty good pace of soybean exports going on. If anything, we probably add more exports, higher crush on soybean oil and meal demand, take stocks down a little bit more, see about a 10.20 to about $1 higher move for soybeans. I'm more optimistic that happening than going the other way. A lot of that has to do with soybean meal, soybean oil demand. And to finish up, okay, soybean marketing strategies, storage return opportunities out into March, August 25, looking for seasonality. If a strong soybean futures market rally occurs, but basis remains weak there too, same script. Hedge to arrives, futures hedges to see what comes about, or wait and store. Consider selling cash, buying calls again. But again, you're accepting whatever you got now for basis and placing your whole hope on futures run up. New crop, use scale up pricing, targeted action dates, forward sales plan. My own thoughts are we started about 10.75, work up to about $13 monthly from March through August, and then after that we're just at risk to whatever could happen heading off into fall. Well, Mark, that's what. How do you respond to that? Are those thoughts on outlook and sales consistent with what you're thinking, or where could we improve them?
Oh, heck, Dan, I think your outlook is always spot on. I love it. A question I've got though, Dan, we talked about we got some pretty good opportunity for rallies into feed grains. Don't we typically kind of see, okay, they're all going to kind of move together. We may have a situation where corn is driving it, but I mean, we're not going to see a situation where corn futures are seeing a very strong rally May, June, July, and beans going to the tank. Wouldn't they be kind of drugged slowly, begrudgingly up a little higher too, or not? And the same with wheat a little bit. Well, aren't they all going to kind of move a little bit in concert or not?
Well, excuse me. I think especially pre-plant, before we get the crops in the ground out here until May, that'll tend to happen just because corn and the feed grains and soybeans will want to defend. They'll want to defend their turf. They wouldn't want that whole futures complex, particularly the new crop bids, to weaken. And again, when you look at the soybean versus corn ratios that we're seeing, and that's in Kansas forward pricing. It's kind of foregone that in Western Kansas we're probably going to plant a lot of feed grains and wheat, but that's not the case in Central and East, where soybeans are, they compete very well. So I think and that'll be the case in the rest of the Corn Belt too. Up through May, June, well, up through May, I think they'll especially move together. Uh, wheat is a different critter. I think we saw that here of late. We had days where corn and soybeans were pretty strong. I think corn up 6-8 cents, soybeans up 15-20, and wheat in sympathy with corn and soybeans up about 3 or 4. Yes, they do tend to move together, but well, again, so this deal with corn and wheat in Southwest Kansas at the local level, the overall market for futures had moved high enough, drug the corn price up, and then but wheat was sideways, stagnant. So it brought about that situation where, gosh, maybe it's time to feed wheat. It seems to pencil out more. So my answer to your deal is yes, they do tend to move together. On the margin, you'll see up through planting time, especially the corn and soybeans move together. Wheat may or may not. Just depends on really the factor that keeps wheat from just going off on its own is that it has to stay. It tends to stay pretty close on the bottom side to corn, or it'll find itself all being fed. So. What do you think of those price goals, Mark, in terms of note for the beans, 10.75 to 13. I think for corn, I believe went up to about 6. That's probably conservative. What would you look at for that for monthly increments as you move forward?
Well, hey, I don't do Outlook. I always, like I say, I always turn to you on that, but I am encouraged. I'd love to see some $6 corn, given what we've seen, especially if it's $6 cash. That would be fantastic. And I think a lot of farmers in Kansas would love to see that too.
I think what you've seen here is that this seasonality is pervasive, and so I it tends to come almost every year in the markets, and so I when you put together one of those winning the game grain marketing strategies, you're basically counting on that uncertainty about the size of the crop to give you some forward pricing opportunities before you head off into fall harvest. And for corn, especially about like 75-80% of the years, we do fall off into the fall after that uncertainty goes away. For soybeans, it's not quite as pervasive. About 2/3 of the years, we tend to move lower because more influence from South America in the middle of that. But so what you have there is we're kind of harvesting the uncertainty in those grain markets before all that goes away and takes us lower into fall for the feed grains and oilseeds.
Folks, if you have questions, go ahead. I'm gonna set it up so you can unmute and just talk here. So hang on just a second. Yeah, if you want to talk and unmute and just talk to Dan and Mark, go ahead, or you can put a question in the chat here.
Hey, I might respond to one of the questions that were in the chat. Let's see here. And I typed an answer in there. Dan, I'd like to hear your thoughts on that. I think the question one is there a reliable source for U.S. corn, soybeans in farmers' hands on farm or commercially stored? And then he's wondering how to calculate how much 2024 crop is yet to be priced. And I shared two things that I'm aware of. One, obviously the December stocks, our quarterly stocks reports. And what I'll do a lot of times then is I'll take that and I'll just, break out, how much is on farm December 1 in Kansas, and then how big was the Kansas crop. And, for this year, for example, that would have suggested that maybe 23% of the crop we harvested was on farm. But the problem is it doesn't tell you how much of that's really already contracted, right? Maybe it's already contracted to go over winter into an ethanol plant or to a feed yard, or how much it's going to be just stay right there on the farm and be fed. So it doesn't really tell us how much can be dumped on the market. And the other thing that I'm aware of that kind of gives us a handle on, how much is sold, but it's incredibly lagged, is that it's in the monthly price reports that, your Kansas seasonals are based off of. Once a year, they'll publish those weights. Yeah. And, for example, then, if you look at the last 15 years, 68.3% of the Kansas corn crop is sold by the end of January. Now, again, you look at all that data over time, it varies year to year. I kind of wonder how much, and I'd love you to, I'll shut up here in a sec here, how much corn was sold fairly early this year, just because, man, we had notes to pay. I know over the last 2 years, we've been really chewing through a lot of our working capital. I wonder, did we see a lot of cash sales and people not hold on because it was like I had some bills to pay? That again, to answer the question, I don't have a good handle, how that all broke out.
Well, in the room at Cover Your Acres, when I was getting questioned, i.e., skewered by the audience, saying, "Well, what about the lack of selling opportunities?" Well, they were living that situation. So at least in those parts of the state, there had been some aggressive pre-sales and out there. And the people that were coming up and speaking to me still had some unsold, but if so, it might be more of a phenomena to the west. I'm not sure, but to the west and northwest, but lot of sales and apparently. Again, we got so low in the middle of the summer that when we got up to that 430, 450 area, we sold a lot of grain. So obviously also there's a fair amount unsold yet in farmers' hands. And I don't have that quarterly. Actually, I have the quarterly stocks report with me. I'd have to dig it out, but we can find out what the amount of rats. Yeah, here it is. Let's see. So hang with me just a second. For Kansas, answer the question: how much on December 1st of corn was on farm as opposed to in commercial hands? So total on December 1st in Kansas, 62.4 million bushels. Out of that, 14.5 million were on farm and 48 was commercial. So that would say, I don't have my calculator, but that's about
23%.
23% still in farmers' hands, and the rest of it's sold. It wouldn't take much to go and compare that Deese report all those years to see if that's high or low. And that's what I should have done. But so it looks like 65+%. Well, 22. Yeah, that'd be 78% has already moved. And we're trying to. So if you're still holding on to it, then how and you're an opportunist, you think, you know what? There'll still be somebody out there in the summer months before the next harvest that still needs grain. So you could hold it for that, but it's kind of it's a speculative entrepreneurial position, I guess.
Hey, Dan, on that point, percentage of the crop, let's see here. Okay, the 15-year average is 23%. This year, it was also 23%. Last year, 26% was on farm. 26% of the Kansas crop last year was on farm. The year before that was 30. So over the last few years,
we're moving
been holding a little
we're not
bit more
keeping it
on
around.
farm. We backed it off a little bit this year.
Yeah. Yeah, it's still within the again, as we were talking about, you gotta have that percent estimate numbers, although the stocks numbers are the stocks numbers are to the bushel for commercials, but they're an estimate for the on-farm side. So still majority sold.
Dan, there's another question on there. For 2025 planting, area that can't raise corn, beans, or milo, question. And I guess I'm not really sure exactly what that question is. I don't know, John.
Looks like if they can't raise corn, you got a choice between beans and milo. Which one would you go with?
Oh, got it.
Well, the first gate cut is, are you in the western third of the state or the eastern 2/3 of the state? You know, and you can, and are you under irrigation or not? And if there's that area that can't raise corn, I would wonder if that's, I'm guessing that's mainly non-irrigated and absent herbicide carryovers and all that other stuff. Uh, out of those, uh, I know there are people here that are on this call that signed up for it that are strongly vested in the sorghum industry. So I do not want to say anything negative about sorghum. And maybe the most honest thing I can say is that the trade issues are affecting both of those. It's already hit on the Milo, in terms of China not coming aggressively in, and it could hit on the soybeans if soybeans become an issue again. From where? From China. So I I so John, I would not. I hesitate to say one way or the other, but this trade issue has added more risk to either one of those, and really, I would say, what are you? It's kind of like corn. What are you good at? What's your comparative advantage? If you really can raise good Milo, and know that Milo can sorghum can, if it's not moving as a in the export channels, it's a competitive feed grain. It can be fed. It can run through ethanol plants. So the thing that would happen with poor exports to Milo is that it still would be used, but it would go to the lower. It's not lower. I hate to say lower value uses, but exports wouldn't be driving the train. It'd be the other uses. Does that make sense?
It does to me, Dan. I thought that was a really good answer. Because, and if you look at, the ag manager cost of production across state, you, me, and Rich tried to work together and put together sort of I call it a composite cost of production. And, for soybeans for 2025, we had 912. I didn't have one for grain sorghum. Sorry about that. But I think your point of this, I think the one thing we see, and I think if you look at, say, Farm Management Association data, there is almost more variation from farm to farm on what your costs are. And again, to your point, hey, what am I for whatever reason, really good at growing? And I think that producer, John, people need to kind of look at what do we grow better? What are my expected costs in doing that? What can I follow that crop with, and things like that. So I think your answer that it's kind of a unique and individual decision, and you need to kind of look at your own crop costs and things like that, expected yields is probably what people have to do.
Yeah. What's your comparative advantage? As an economic perspective. What do you compete really well at with farmers around Kansas? And some of that might have to do with whether you're near an ethanol plant, if they're willing to take sorghum or not. Or if you're near right now, if you're down southeast Kansas with the new plant in Cherryvale or near Ellsworth, you answer that question. Well, I think I got a processor about 15 miles from me. I think I'll go that way. So those usage options, the logistics of getting to them are a big deal.